Real estate investment trust, also known as REITs, is a big sector in the stock market right now that's been pretty much impacted directly by the global issue hitting us. But when it comes to REITs, guys, not all of them are created equally. There are many different sectors within the REIT space. You have retail REITs, you have mortgage REITs, you have healthcare REITs, you have plenty of different kinds of REITs, some of which are hit harder than others during this global issue. So in my opinion, I don't think it's fair to really make a blanket statement saying that REITs are a bad investment or even that REITs are a good investment. I think you really have to take it on a case-by-case basis, and that's what we're going to do today with three of the largest retail REITs out there. We're going to be talking about SPG, Simon Property Group. We're going to be talking about Tanger Outlets, and we're also going to be talking about, of course, Realty Income. Now, if you want to see a future video on me comparing, say, mortgage REITs or healthcare REITs, let me know in the comment section down below. Hit a like on this video and share this video with a friend as well. The more exposure we get on these videos, the more I understand that you guys want to see more content like this. Okay, so let's get started. It's going to be a fun one. We're going to go over some of the top retail REITs like we talked about, and we're going to go through their financials and figure out which one of these three, if any, makes sense as an investment right now. So comparing the three REITs here, we got Simon Property Group, Realty Income, and Tanger. And right off the bat, you can see that the size differences between these companies is quite drastic. SPG is the largest with a market cap over 41 billion. Realty is in the middle with around 26 billion market cap. And Tanger is the smallest by far with just over a $2 billion market cap. This could tell us a few things. Maybe SPG and Realty Income are in a much stronger position here to weather through the storm. And maybe Tanger is actually in trouble here. But we'll have to wait and see. We'll have to look through their financials a bit more to confirm any of these suspicions. Now, as with all other sectors in the market, looking at the PE estimates for 2020 is pretty much a wash, especially for this industry. However, we can still use this information to see how the market predicted that these companies would have done before the global issue hit. Now, based on this information, in the last year, SPG and Tanger were fairly cheap, and Realty was extremely expensive, even more than the overall S&P 500. Looking forward to the next 12 months, SPG still remains fairly cheap here. Tanger doesn't look to make money, so it doesn't have a PE, and Realty Income is still expensive. This concerns me to have a PE this high in a market like this, so this is something to note of if you are considering Realty Income as an investment. So now let's try to understand further why Realty is so expensive compared to the other two by looking at their growth. So between the three here, year over year, SPG was essentially flat, Tanger declined by nearly 3%, and Realty, well, it grew by over 12%. Looking forward, Realty was expected to grow again by nearly double digits, but again, the global issue will most likely impact this directly. Nonetheless, the takeaway from the revenue growth is that Realty is growing nicely, while the other two are seemingly struggling. I also like looking at net income here to understand how the profits of a business is growing, and the 3-year compounded annual growth rate here shows that Realty Income has been growing by double digits, which is extremely healthy. SPG has seen some modest growth here under 5%, but Tanger is concerning as their profits have declined over 23%. And guys, this information is from the last 3 years when the economy was booming, so it does concern me now that things have changed and malls are essentially shut down, how these companies will get through this and survive. We'll look at their balance sheets shortly to find out if they have enough cash to actually sustain themselves right now. Now, as with any business, profit margins are important to look at because we want businesses that have high gross and net income margins for good sustainable growth. Here we see all three businesses, being REITs, have a good gross profit margin, with Realty being the best, and with net income margins, SPG comes out on top. Once again, Tanger is in third place for both of these metrics, so things aren't looking too strong here for this company. Okay, so enough beating around the bush here. Let's take a look at their statements, starting with their income statement. SPG pulls in the most revenue of the three, nearly $6 billion, whereas Realty pulls in $1.5 billion and Tanger pulls in just around $500 million. Translating to net income, which is their profits essentially, the story remains consistent. SPG pulls in $2.1 billion, Realty $436 million, and Tanger at under $90 million. Now when we jump to their balance sheets, we can see that these companies own properties, so their cash balances are usually fairly low, as we can see here. SPG sits at $669 million, Tanger at $18 million, and Realty at $54 million. But updating this image here after digging through their assets for each company on their balance sheets, SPG assets sit at 31.2 billion, Tanger sits at 2.3 billion, and Realty sits at 18.5 billion. Now, because these are REITs and they own physical property, this is where their true value lies. Now, comparing their debt loads to their actual asset value, you can see that all three of them seem to be in good shape here and in good standing, because their physical properties that they hold, the physical real estate, is worth more than the debt outstanding. That being said though, guys, real estate prices will probably take a tumble soon enough, so there's a risk here that with such low cash balances and high debt loads, there could be potential issues for these companies moving forward. Now finally, what we need to do is look at the dividends here, because that is one of, if not the biggest appeals of these stocks. All three of these companies have a good dividend history when compared to the overall market, but SPG and Tanger have outstanding dividends right now. SPG currently pays 15.6%, Tanger pays a whopping 26.98%, and Realty pays a modest 5.5%. So far, none of them have actually cut their dividends, and Realty actually raised it recently, so that shows some strength here despite these tough times. Tanger and Realty have 26 years of growth, so I don't think that they want to lose this title of being a dividend aristocrat, and in my opinion, they will do whatever it takes to preserve that dividend. Payout ratios are all high here for these companies, which is expected as they are REITs, and they are required to pay out 90% of their income, so this is pretty much a non-issue here when it comes to these type of stocks. For other businesses, if we saw payout ratios this high, I would pretty much be raising a big red flag and be concerned with that dividend. So this is kind of where we sit today now, going through their information here with Simon Property Group, Tanger, and Realty Income. Although these companies have been great to investors, rewarding them in the past, my fear is that there is a fundamental shift happening right now in the world, and they could have a material impact on all three of these businesses. A lot of businesses, especially smaller ones that rent out these office spaces, have realized that they can just essentially work from home, have most of their employees work from home, and still be pretty much as productive as if they were in the office. This of course helps them reduce their payments because they won't have to rent as big of an office space, if any. And this is a realization a lot of businesses may come to as we continue on with this global issue. So how does this affect these companies? Well, in turn, it's pretty much gonna lower demand for REITs in general, because it's gonna be less people that want office space. And as a result, prices are gonna drop. And of course, if prices drop, their revenue and their incomes are going to drop as well. So that's a very real concern that I would keep in mind if I was investing in any of these three stocks, because it is a possibility that could play out over the next few years. But does that mean these companies are going to go bankrupt because of this? I don't think so. I think there'll still be a need for office spaces, but just not as much as it was before. Realty Income, for example, has customers like Walmart, Walgreens, and Dollar General, which are all going to be just fine through this issue, and their demand for physical retail space won't be changing even after this global issue. However, they also rent out to businesses like AMC and Lifetime Fitness, which may be at risk here, but because they are so well diversified in their tenants, Realty Income should be able to recover even if a few of their tenants go bankrupt. Simon Property Group, on the other hand, owns mainly malls all over the world, and this is a company that could see a much bigger impact from the global issue. Will people stop shopping at malls once things recover? Maybe some will, which will surely have an impact on their future income, but majority will probably still continue going to malls, at least for now. I think the need for malls will probably still be around. So again, I don't think Simon Property Group is going to be going bankrupt here, but it could struggle with slower or declining growth going forward. Tanger, the third of the bunch here, like Simon Property Group, is another one of those REITs that operates malls, more specifically outlet malls here, but they're mainly focused on the eastern part of US and Canada. They're also much smaller than the other two players here, and as a result, there is some risk for Tanger, but I feel that if this company struggles, Simon Property Group may actually look on taking some debt and possibly acquiring this company. This would help them expand their portfolio and give them a bit more coverage across the US and Canada. Out of the three stocks we covered today, I would say that Tanger would be the riskiest of the three by far, which is probably why it's offering such a massive dividend yield as well, because the price has dropped quite significantly. So really the bottom line is that each one of these companies is going to have a fundamental issue to overcome once we get past this global issue, which is the declining demand for real estate space. In my opinion, Simon Property Group and Tanger will have a very tough time getting back to their highs prior to this issue, if they ever even get there. But on the flip side, I think that Realty Income may actually recover much sooner than these two other companies and may actually make new all-time highs sooner than expected. It kind of got pulled down and dragged down with the whole REITs sector, and I think after looking at their portfolio, they're poised in position to really come out of this just fine with a few little bumps and scratches here and there. And I think a lot of investors are starting to realize that now as the stock starts to recover. And I'm glad to really see that, because I know a lot of you guys own Realty Income, and some of you even own SPG, Simon Property Group. But let me know in the comment section down below, if you were to start over today, would you still own these REIT stocks, or would you skip this sector altogether? I'd love to hear your thoughts in the comment section down below. As of recording this video, I personally do not own any of these REITs and don't have any plans to buy them in the near future. Guys, hope you learned something from this video. If you did, remember, drop a like down below and hit that subscribe button if you're brand new here. But either way, don't forget to invest positively, and I'll see you in the next one. Peace.